Have a defined benefit super and wondering how it impacts your age pension? In this video, I'll break it all down for you with a clear example. Let's get into it. Like other super funds, defined benefit super has two key phases. First, you accrue defined benefit interest while working, based on factors like your contribution, final salary, and years of service. Then when you retire, you access your benefits. Your option can vary depending on your specific scheme. Some funds offer a lifetime pension, while others allow you to convert part of your benefit into account-based pension or use a combination of both. An account-based pension is simply the retirement phase of a standard accumulation-style super fund. If you're using all or part of your defined benefit to start an account-based pension, make sure you watch that video as well to understand how it's assessed and how to make the most of it. In this video, however, we will focus on defined benefit income streams, which are often lifetime pensions. The way they are treated by Centrelink is very different from the accumulation style of super. If you're in the first phase of accruing defined benefit interest, it's very simple. It's not assessed under either the assets or income test for age pension purposes. If you're in the second phase, for the assets test, defined benefit income streams don't increase assessable assets for the simple reason that there is no capital amount supporting the pension. When it comes to the income test, Centrelink assesses the gross payment minus the deductible amount. The deductible amount is a tax-free component of your payment. You can find this information on your statement or request it from your provider. Now, here is where it gets interesting. For most defined benefit pensions, the deductible amount is capped at 10% of gross payments from 1st of January 2016. Exceptions apply to certain military defined benefit income streams such as these. There is no cap, and the full tax-free component can be deductible for income tax purposes. Let's have a look at an example. John receives a defined benefit income stream from a non-military public sector fund with a gross annual payment of $40,000, which includes a tax-free amount of $10,000. Under the assets test, John's defined benefit income stream is not counted. Under the income test, as explained earlier, the formula is gross annual payment minus the deductible amount, which is capped at 10%. John's gross annual payment is $40,000. His tax-free amount is 25% of his gross payment. However, under the 10% cap rule, the deductible amount is limited to 10% of $40,000, which comes to $4,000. This means $36,000, which is 90% of his annual pension payments, counts towards the Centrelink income test. If John's defined benefit income stream was from a military scheme where the 10% cap doesn't apply, the deductible amount would be the full tax-free amount, which is $10,000, and only $30,000 is assessable income under the income test. If John's tax-free amount was below 10% of his gross payment, say $3,000, the deductible amount would remain at $3,000. and $37,000 counts towards the income test. I hope this has been helpful. I'm creating a defined benefit series and will be dropping those videos in the coming months. Topics include the pros and cons of defined benefit schemes, tips to maximize your final benefit, how to use defined benefit schemes alongside accumulation style of supers, and more. Defined benefit income streams by nature are quite inflexible, leaving little room to adjust them specifically to increase age pension entitlements. However, by managing your other accessible assets and income effectively, you can still increase your age pension. Watch this video to learn more.